We could, of course, discuss today's market action, some predictions, the typical stuff we typically do, but we've got plenty of videos. We made a video yesterday and the day before that we talk about that. Today, we're gonna go a little bit more in the weeds and talk about this peak inflation notion and why we're not 100% in what is truly the consensus camp. I get it. People want to say the consensus is negative. That was maybe possibly kind of the case. At least it played out in the past market action. But I would say right now, the consensus is keeping it simple. They're keeping it simple. Inflation has peaked. It's coming down and it's going to keep coming down. And don't you say anything else about it because that's what's happening. Well, I've got my qualms with that notion. I challenge these people, I challenge them to explain inflation and inflation coming down without a peak in oil. I think that makes a big portion of the peak inflation argument. And we can see that if we go to core. Now, core, I would say, even though it excludes food and energy, there's no getting around the fact that oil and energy prices impact every aspect of the economy. This is the juice, this is the oxygen for the economy, oil. That's why it's so important when oil prices rise. And we obviously saw a pretty big impact when they rose very quickly on inflation. And I would argue we've seen a pretty big impact on the way down. Now, everything I've said here is moot, I guess, and you can just stick in the peak inflation mainstream camp if you believe oil prices are going to continue to go down. But unlike the past several months where oil prices have continued to go down at a pretty steady rate, I don't think that's going to be the case going forward. And we didn't really break 70. We did for a split second, haven't broken it since. I think that's going to serve as the low, and 70 is going to serve as the floor. And we have a multitude of reasons why this might be the case, and actually some counterpoints that we'll also address. We'll start with the counterpoint. Somehow, believe it or not, 800,000 barrels left the SPR last week. That was a surprise to me. I thought we were done with that. The White House had previously announced they were going to refill the SPR and did some purchases. I expect that to be the case, but they're probably going to fight pretty hard to keep oil prices low, and they want to say, hey, we will drain our reserves for wartime measures the same day, that we're getting cyber attacks on our airports. Yes, US and Canada, I didn't hear that. I listened to CNBC all day. I heard no cyber attacks. I find it highly suspicious that the United States and Canada both had complete airport technology shutdowns on the same day, but we'll leave that to the experts, right? We'll leave that to the experts. We'll put full faith and credit in the experts. Anyways, oil prices. They got to refill the SPR. They're saying they're going to refill it at 70. That should serve as a floor. Either way, we talked about yesterday how the EIA increased its demand growth expectations for this year. We've talked previously about how OPEC sees more demand growth than supply growth this year. We look at the fact that as oil prices fell, we had SPR releases, we had China lockdowns, major China lockdowns. Both of those forces seem to be reversing. We have Atlanta GDP now being revised up. So a number of reasons why we should expect the oil market to remain tight, because it is tight, and for prices to continue to rise. They're up 3% today. It seems to me that the market is not paying attention. The market's rallying up over 1%. The stock market, the bond market, yields are down across the board. Oil is definitely something to consider and definitely an aspect of inflation. It's not all of it. I would say money printing is more important than oil prices. But if you compare oil prices now to where they were in 2008, we're cheap now. We have cheap oil. We've printed a lot of money and caused a lot of inflation. So if you look at the nominal number, yeah, we're pretty expensive. If you look at the real number, no, we're not. So we'll see what happens. Oil prices. I think inflation, to sum this up, I think inflation has come down in large part because of oil prices. I think oil prices are at a bottom. And while I think CPI tomorrow might be a dovish surprise, whatever you get what I'm saying, the next few months open up a little bit more uncertainty. And I think this is why the Fed is being rather hawkish. So we'll see what happens. We haven't really seen a huge budge in core. Tomorrow we're supposed to get some 5.7%. That will definitely provide some insights. But for the amount of celebration, the amount of market rally, the full conviction in peak inflation that some seem to have, I would definitely expect to see some more serious blow off in core. Even if we get that 5.7% number, we're very much going to still be in a sideways range that has come down and then hit new peaks. And I think that's what the Fed's looking at. So peak inflation, yes, I do think the worst of inflation is behind us, but I don't necessarily think it's going to be as smooth sailing in the next several months as the market, which has rate cuts this year, seems to project. And I think that's going to lead to some market turbulence, and it's something we should be prepared for. And, while maybe some want to trade the CPI tomorrow, we've got Fed members talking. They're going to add some additional nuance like we're trying to do today. And we'll just see what happens. This is not a casino. This is an investment paradigm. We're trying to preserve and grow wealth and capital. And gambling is a losing strategy. So at some point we'll get long. But we don't want to get long yet. We think there's more pain to come. One last thing I want to talk about. So yesterday, Wells Fargo closed their mortgage business to non-clients and non-minorities. This is very interesting. Why is this very interesting? Well, they're keeping it up to only clients who have to have banking relationships with them, have their savings with them, have to provide them with access to their assets, and a more complete and holistic financial picture. We've seen what's happened in used cars. Tremendous declines in prices. Interest rates have come up. That's impacted used cars, and it will impact used houses. We've also seen delinquencies in cars pick up a little bit. Many are expecting repossessions to pick up in the coming months. And it seems like the same is possibly occurring, according to Wells Fargo pulling out of this business, could possibly occur in the housing business. So I don't think it's all dandelions going forward. I'm concerned. I'm on edge. I'm not trying to go, balls deep and everything. If you go back to the early stage of this channel, if you go back to the March 2020 videos, starting on March 19th when we called the bottom after not wanting to have called the bottom, you will see we definitely have periods in our life that we will go all in and definitely take on risk. Okay, this is not a short selling fund. But here we are, wanting to be short. So that's today's video. We'll see what CPI looks like tomorrow. And until then, peace out.